Welcome to Idea to IPO. My name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 1 million members among all our meetup groups all around the world. We've organized, promoted, and produced over 5,300 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. Thank you. Thank you for all your support. We organize venture capital panels, legal workshops, networking events, and more. We hold an event every day of the week. Check out our schedule at ideatoipo.com. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant. Stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is a global aspirational ecosystem that attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley or the greater San Francisco Bay Area? Who here was born and raised in Silicon Valley or the greater San Francisco Bay Area? Wow, that's like 7 of you. That's a record. Well, welcome. So whether you were born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet, build relationships, and grow your network. With regard to value, it's important that we provide value at each and every one of our events. Not just value for your money, which is important though, because we know many entrepreneurs are struggling financially. So we make sure our events are free or affordable. And if one of our events has a cover charge and you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at most of our speaker events, we make sure that we provide a delicious buffet. Is that a delicious buffet? Well, I want to thank Wilmer and Snell and Wilmer. Snell and Wilmer for sponsoring that delicious buffet. So let's hear it for Snell and Wilmer. More importantly, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Anyone here getting any younger? Besides that young man in the back and this young lady and our panel. So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, and lots of other players in the Silicon Valley startup ecosystem. Tonight, we're grateful to Snell and Wilmer for hosting us once again at this beautiful venue. Is this a beautiful venue? We've held many events here, and we look forward to many more. So again, let's hear it for Snell and Wilmer. Applause. Roger, would you like to say a few words? Just a few.
All right. Well, welcome everybody. How you all doing tonight? Really huge welcome, and thanks very much for being here. Just a few words about me and about Snell Wilmer. I'm a recovering entrepreneur. I was an entrepreneur for 10 years before I became a lawyer. I head up our emerging growth and venture capital practice group, dealing with companies from inception all the way through IPO. For those of you that don't know Snell, it's a law firm of over 550 lawyers and 18 offices, and all the different practice groups that are important to startups, including, hopefully, for you guys, the public company practice group, the venture capital practice group, IP, labor and employment, and God forbid, litigation department. So with that, I'll turn it back over to Robert. Once again, thank you for coming. Oh, just a couple of quick event pitches. Tomorrow night, we've got Natalia Barina. I'm doing a fireside with her. She's a VC at Storm Ventures. She was instrumental in Meta AI's AI program, Salesforce, and a couple of other companies. We're going to do a real deep dive into venture investing and AI tomorrow night. I think, there are about 15 seats left. So if you are interested, take them today. And then in a couple of weeks' time, we've got our monthly Palo Alto pitch nights, 10 curated companies, and also a venture panel. So if anyone's interested in pitching, go to Luma and register. Thank you.
Applause, Raj. Some of our other partners are here tonight. I would have them also say a few words. Let's hear it for Suprio and Cordify. Applause.
Thanks, Rob. Good evening, everyone. Welcome over here. We are sponsoring. I'm happy to be here. I'm Suprio from Cordify. At Cordify, we work with early stage startups as well as late stage and companies who have reached that scale, looking to stabilize their product portfolio and expand it to enterprise scale, reach to hundreds of thousands of users. So we help you on that product journey, right from MVP to your scale up. Happy to be here. We are looking forward to interacting with you during the course of the evening. Thank you.
Next up, we have Johanna and Enviri. Applause.
So good evening, everyone. So Roger is a recovering startup founder. I'm a recovering global event planner. So how many of you enjoy attending conferences like RSA, Salesforce, Dreamforce, TechCrunch? Maybe you attend rock concerts and live music events. So here's a big catch. Live events account for 10% of global carbon emissions worldwide. That equals every car on Earth running their engine nonstop for 2 years. So what I do in my former life, I was planning these events and I saw a lot of inefficiencies. So now what we do at my company, Envir, is that we make the emissions, which are, by the way, most of them are not visible to us. They happen behind curtains. So we automate event-specific impact tracking, allowing the venues to work with their customers to reduce emissions and get to net zero carbon. So I'll be standing there. Come ask me more about emissions at live events, and happy to chat.
Next up, we have Jana and New York Life. Applause.
Thank you, Rob. Good evening, everyone. My name is Yana Vasileva, and I'm with New York Life. I do help individuals, families, and businesses, startups with financial planning and retirement strategies. So please come see me tonight at my table if you have any questions or you like to connect. And also, please fill our raffle for tonight. We do have some fun surprises, and I hope you enjoy your evening. Thank you.
Jana, what's your prize?
Sea candies.
This prize is Seas Can't. Next up, we have Melissa and Atadon. Applause.
Thanks, guys. Hello. My name is Melissa. I'm with Atidan Technologies. We help enterprises accelerate their AI initiatives with agent-based solutions. We also look for other companies that want to partner up and get some big projects done. So if you want to connect and talk more, let's do that. Also, we got a $25 Visa gift card, so enter the raffle. You can win some prizes.
And also, one of our panelists is an esteemed author, Jacques Mikowski, and one of the prizes is, well, we have two of the prizes. But why don't you tell us about your book real briefly?
So yes, I started 5 years ago giving classes on how to take a company to market. And after 5,000 entrepreneurs have seen it and liked it, I decided to turn it into a book. The book is in the raffle. It looks like this. It's called The Market Entry Strategy and talks about how you take a company to market. I have a few copies here. People want to get it as well. That's all.
And you'll sign it.
And I'll sign it. Yes.
All right, so enter the raffle. That's at 8:30 p.m. You must be present to win. So though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go check it out. We have tons of videos there. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. Our partner in this endeavor is Michael Payne, one of the top professional videographers in Silicon Valley. Let's hear from Michael. Applause.
Hello, my name is Michael Payne, and I help companies and individuals tell their stories. It could be a product video, it could be teaching your clients how to use your product. If they don't know how to use your product well, your product sucks. If they do understand it, you are God. So I can help you with that. I could do explainer videos, conference support. If you have any need for my services, please reach out. Thank you.
Well, let's see who's in the room tonight. Who here is an early stage entrepreneur? What's the difference between a pizza and an early stage entrepreneur? A pizza can feed a family of 4. Who here is an investor? Who here is an enterprise employee? Who here is a government employee? Who here is a former government employee? Who here is a student or an academic? Who here is a journalist or a media person? Who here is here for the delicious buffet? Right. Well, if you know something different about our delicious buffet, we have a new initiative. We're striving to be 100% zero waste. So, as we have a lot of non-disposables. So we're probably at 98%. So appreciate all your support in that. So here's the schedule for the rest of the evening. Our panel will hold a brilliant, compelling, dynamic, entertaining, and scintillating discussion. Right, panel? At 8 p.m., we'll open it up to questions. For sure. At 8 p.m., we'll open it up to questions from the audience, and that will take us to 8:30 p.m. We'll have our raffle drawing. We'll end the program. You can stick around, network, socialize, connect. There will be an after party. More on that later. So without further ado, I'm going to hand it off to our distinguished moderator, Roger Rappaport, partner at Snell & Wilmer. So let's give it up for Roger and our panel. Applause.
All right, we got a lot of ground to cover, and so let's just dive right into it. And what I'd like to do is just go along the panel. If you could just introduce yourselves, tell us a little bit about your background, tell us about what you're investing in, your check size, if you lead, you follow, and what companies you're really looking for. Jennifer.
Sometimes it's easiest to go first. So welcome. I'm Jennifer Vancini. I'm a general partner at Mighty Capital. We invest in early stage Series A or a little bit before. Our thesis is very much centered around products. We believe simple insight, great products drive great businesses. And the reason we're focused on that is we have a unique network of more than 500,000 product managers that we leverage for insights in terms of where we're investing, like seeing where AI is going before other people do, seeing where corporates are spending money, and to help our portfolio companies sell more, hire, get exited through strategics. Check size, if we're leading, which we do in about half the deals, 3 to 5 million check. We're looking for companies more on that rational side of Series A, so not the $50 million crazy valuation, Series A, but you're looking to raise $5 to $10 million at reasonable terms. What didn't I cover that you want to know?
Stage you got, check size. I think you got all the basics.
Okay, I got the basics, and I know we have a lot of other people here to cover. So.
All right. So next up is Eric Verblue, managing partner at Tunilis Ventures. Did I get it right?
Close. Okay. Eric Verplu. Nice to see everybody. As our illustrious moderator said, I'm the founding partner of Tunilis Ventures. At Tunilis, we focus on late seed stage, so that's post-revenue, pre-Series A, and invest only in category-creating companies. So companies who are inventing brand new industries without competitors. My background, I spent 11 years as a partner in 2 large venture firms, started 2 venture-backed companies, got my PhD and MBA at Stanford. Check size, was writing $500,000 checks in Fund 1. We'll cut over to $1 million checks in Fund 2 here in a few months.
And do you follow on as well? And Jennifer, I forgot to ask you as well. You do follow on?
Yeah, we definitely have reserves. Our default is to follow on as long as the company is doing as promised. It's a really key thing to look for in an investor.
And Eric, do you follow on as well?
Never. And it's the worst thing to ever get in an investor. No, I'm just kidding. No, our strategy, we will do an SPV outside of the fund to take our pro rata in cases that are attractive.
Okay, excellent. Great. So next up is Sanjeev Kumar, a venture partner at Fusion Fund.
Hi, everybody. I'm Sanjeev, and I've been at Fusion Fund for about 3 years now. The fund invests in enterprise AI, tech bio, which is technology for biology, and industrial AI. So almost everything we do relates to AI, either at the systems level or at the applied level. And our check size is about $1 million to $4 million, sometimes $5 million, and we set aside a pool of money for follow-ons.
Did you guys lead or follow?
We tried to be a lead in a seed round, and we do pre-seed as early as just the team, pre-revenue. What else? I've been in the Valley for a long time, working primarily on data-related products, databases, data integration, data engineering, and now data science.
Excellent.
So-
Great. Thank you. Next up is Deborah Mugged, Managing Director and Co-founder of Nexstar Venture Partners.
Hi, thanks. Yes, so I spent about 20 years in IBM Ventures, which was interesting because for most of that time, IBM did not do investment. So yeah, that was fun. So I was in M&A sourcing and strategy and helped with due diligence. I also built relationships with investors and founders all over the world. So I got to travel to places where those people congregate and left IBM almost exactly 2 years ago. And I'm starting a new fund, which will invest in vertical industries that I care about and know a lot about with one other partner who was also at IBM Ventures, like energy, climate tech, healthcare, sustainability, agriculture, cybersecurity. And we're looking for game-changing businesses that leverage AI to do something that couldn't be done before. We will invest in seed stage, a little bit of A. We will definitely do follow-on investments because of our M&A experience. And check sizes will be somewhere between a few $100,000 to a couple of million. Did I answer everything?
You did.
Okay.
Excellent. Thank you. So next up is Evangelos Simotis, Co-founder and Managing Director at Synapse Partners.
I've been in Silicon Valley for 35 years here. VC for 25 of those. Did 2 startups, and since very 80s, I've been working in AI. Synapse does 2 things. We invest in early stage enterprise AI companies. Terms and years also is what they move towards. And we advise large corporations and governments on the use of AI. The two are much more good than DCI. Even though they have 2 separate teams working on each side of the house. We manage both private money, corporate money, and our own money, which makes it interesting also. Check size 100,000 per million. We invest in Israel, West of Europe, US, and keep the key. We follow, even though in a few cases we have work for bed racks. Primarily, we invest in the first 2 rounds or 2 price rounds of the combat, and then we'll sometimes we call and even a bad performance of the month.
Great. Thank you. And Last but not least, Jacques Benkowski, General Partner at USVP.
Indeed, general partner at USVP. USVP has been around since the beginning of Silicon Valley. If you care to look into the history of venture capital, I recommend a movie called Something Ventured, available on YouTube, and you will see our founder on it. We've been around for 45 years. We've made hundreds of investments. We just had our 95th IPO today, and we have 2 more in the queue for the summer. So hopefully we'll get close to 100. We do Series A. We lead with a check of typically $5 to $10 million. We take board seat, and we are very active with our companies. Sectors are enterprise software, cybersecurity, consumer, and healthcare IT.
Did you say A, you're primarily at A, or do you go seed as well?
We don't do. We do A. Sometimes we'll do a B, but we don't do seed. We want to see product and customers.
Okay. So just generally, in terms of ARR, companies that come to you, is $1 million, less than $1 million at that Series A stage?
So it's not a number.
Okay.
It's wanting to demonstrate that they have thought through who their ideal customer profile is, and having those handful, literally 3, 4, being able to recite back to us what the value proposition is that they see. And therefore, we want to see a very clear target customer base and a very clear feedback on the value of the company.
Great. All right. Well, let's just dive right into it. The topic is, AI, VC, what's hot. So let's just open it up to the panel. And what are the hottest areas of AI right now? Jennifer, I can see you.
Because I'm sitting next to you, I get to go first. Yeah, it's interesting. I've been in venture for about 10 years, and before that, I was an operator in corp dev and biz dev in the security and mobile industries while they were going through their growth wave. And there were a lot of, what's mobile 15 years ago? It's everything from chips up to application delivery, right? In AI, it's kind of like everything is hot, and I'm sure we'll get in, more deeply into what to look for. I think where there's proprietary data or a unique way to build a moat around the data and the information itself is definitely hot. There's a lot of activity in people building agents on top of large language models. It's hot, sort of like mobile apps were 15 years ago, but not highly differentiating for the most part. So as an investor, we're definitely looking for where is a company baking AI, just like any other technology like we saw with mobile years ago, into a product that's delivering real business value to your customers. So it's a bit of a general answer. It's kind of like everything, depending on where you invest, is where you're going to focus your attention and find those hot companies where customers love what they're delivering.
Are you doing any AI companies that are doing B2C, or is it all B2B?
In our first fund, we did some B2C companies. We don't now. We find we add a lot more value in B2B. We do see B2C things cropping up. It is definitely more commoditized. It's a more expensive marketing thing, but I'm probably not the best qualified to talk to it since we don't focus on.
Adaptive robotics is one area, both humanoid and non-humanoid. And along with robotics is both a hardware side, but also very important how you train them in relatively short time. So there's a lot of work going on there. The other area, and building upon what Jennifer said, vertical applications that are rethinking particular processes. So you can think of incorporating AI as enhancing an existing process, or completely rethinking a process and making sure that the AI is the central component of it. Not the only component, but the central component. So there's a lot of demand for that, and companies that are able to work in either of these two areas, I think they're going to do well and will have a significant moat.
Yeah. So in the first, sorry, I was looking at him. In the first half of this year, more than half of the deals in the world were AI deals, according to statistics. And it's hard to tell. I did some research on this. It was actually very hard to tell what they mean by that. Are they companies that call themselves AI and maybe sprinkled AI dust on top of something? Or are they things that really leverage and understand and they have to use AI? But what this is telling us is that there's a ton of investment going into companies that at least call themselves AI companies. It's higher in the US than in Europe, but it's still pretty high in Europe. The infrastructure aspects of this and things related to LLMs and maybe even Gen AI will commoditize or be taken over by really large companies, which is why I'm more excited about vertical applications that change the way things are done. But you could debate how fast that will happen, and there's still room for lots of different things. I'm not going to try to compete with Microsoft or Google or IBM or OpenAI. So that's a losing proposition. I've seen some people who try to do that. The last thing I'll say that I get excited about is physical AI. I had a friend who put it like this: software is getting taken over quite a lot by AI, and it's really exciting to see things that have atoms in it. So things that have some kind of physical component. I'm not going to invest in hardware, but I will invest in things that have some of both.
Sergey, yeah.
Yeah. So actually, if I could put a framework behind that broad question, right? Because there's a technology stack which is 10 layers deep. And so in the computing industry, there are three corners of a triangle, which is there's compute, there's storage, and there's network. At any given point in time, one of them is the weak link. Right now, that weak link is network. Why? Because there are clusters of GPUs who, on the back end, need to exchange data at such a high speed which we've never experienced before. This is in training of models. It doesn't have to be even large models. But if you have a cluster of GPUs of about 100,000, 10,000, you face this problem. So essentially, copper is not cutting it. So there's an effort to build optical network devices, network switch, which can operate at a speed which is at like petabits per second. So that's one picture. Then there's a picture below this, which is the power behind the data centers, right? So we see there's a lot of activity right now, startup activity emerging out of academia that is trying to get commercialized, is what's called the nuclear microreactors. And these are things that can be connected to a standalone data center. It doesn't have to be on the grid or anything. So there's a lot of work going on there where they're trying to use existing fuel, nuclear fuel that's already been approved for these micro reactors. Now, then let's go above the compute triangle, if you will, which is, of course, vertical AI, right? So far, if you look at traditional vertical SaaS, where the money has been made, where the revenue has been made, is in terms of what are called systems of record. These are systems which other systems connect to for their tracking, billing, sanity check, or other operations, right? So the systems of record with AI are evolving to systems of action. That is, so with traditional SaaS, you had things like there were management systems, there were legal management system. Everything was a facilities management system, right? Now we're evolving to systems of action. That is, what is it that the software itself can do rather than just keep track of things. So this is where the big opportunities are. And coming back to the compute side, there is the transformer model is running, on fumes now, because the cost of its scaling on memory and compute. Memory is linear, compute is exponential. Okay, it is not tenable anymore. So there are companies and there are startups that are trying to build alternatives to do deep learning, like Markovian based models.
But Sanjay, do you think these things are venture investable? I know something about nuclear, micronuclear, because I've been in some climate tech and energy events, and those are venture investable by a small handful of people, and I know who some of them are. But networking, I don't get it.
Are the real, for VCs in general, are the real opportunities the picks and shovels at the app layer? I mean, where's the money going today? Where's the majority of the money? It sounds like those may be sort of very,
Niche.
specific.
So they're
But-
risky. They're actually
Yeah.
very risky as well. But these are capital intensive, and these are venture backed, by the way.
No, they are
Eric-
not generally.
Yeah. So Eric, I know you had some thoughts here.
I want to make I think, important point about hotness and where the venture money is going and that sort of frame of mind, that I think it puts the cart before the horse, and that anytime an entrepreneur is building for what they think can get funded or what they think the venture community wants right now, I think you've screwed yourself up.
Absolutely.
And that the most important thing is a maniacal focus on the customer need or the market problem you're addressing, not what buzzword I think the venture community is going to be in love with this quarter.
I wasn't suggesting it. I think the best founders are the ones that have felt a really deep pain in their prior life or a current job and are solving a very particular problem that they've experienced themselves. They're not going out looking for a problem to solve. But I was just saying, like, from a venture perspective, are there areas, because obviously the foundational models, it's really capital intensive, but it seems like, just based on my own clients, at the app layer, it seems like there's a lot of activity in funding. I mean, are you guys seeing the same thing, that's where a lot of the investments are going?
There is unbelievably rich time. My CEOs complained 2 years ago about how expensive it was to, per token with the foundational models. This year, they're not complaining at all. And 2 years from now, it's going to be too cheap to meter. I mean, in our lifetimes, we've not seen these kinds of price falls over time. I mean, it makes Moore's Law look like a pathetic little trend. I mean, we're seeing 10x reductions in price every year with clear line of sight for another 10x in the next year.
And look at what people are charging. You can get Lovable for free, or $25 a month.
So I think
Actually, I was talking about all the areas I mentioned are the ones we've invested in already. Okay. So, but to answer your point, there are. I'll give you one example, recent example, which is training of sales reps. Their managers. It's a very high, attrition job. People need to come up to speed very quickly. So there's a very nice applied AI example where AI does the role play of the customer. It can be an offensive one, a friendly one, or to train. And not only that, it actually the system helps create the playbook for success of a sales rep.
A lot of great opportunities in agentic AI
Right.
sales. I've got a couple of clients really
Yeah.
exciting. Jacques, I know you had some thoughts.
Yeah, I think probably never in the history of venture so much money is going to go into fumes as we see right now. I was a CEO between 97 and 2004. Seems exactly the same patterns. Incredible amount of buildup ahead of demand, of real demand. We're building nuclear reactor to power data centers to do something. Are we going to make money anywhere? And I think the hardest thing, both for VCs and for entrepreneurs, is the underlying speed of change of the underlying technology makes it almost impossible to know what to build. I'm just going to take everybody's attention. How long ago is the first time you heard the word agentic? It's less than a year ago. Like a year ago, we didn't know what agentic was. And a year from today, there'll be something else which we have no idea what it is today, but is likely to not be agentic. And so when you're thinking of building a company that's built on a technology stack which is changing at this speed, you really have to think about how you're solving a problem and making it sticky. Because, Cursor or any one of those things, the same way they went from 0 to 100, the next thing is going to go from 0 to 100 and it'll go back to 0. And so that is a real difficulty for both entrepreneurs and VCs when you live in a world like this. And, we're making investments, but my God, are we very, very, very careful.
Yeah. A couple of things came out from something Deborah said, and I think also from something you said, Jennifer, I'd like to touch on. First off, from your perspective, Deborah, how are you differentiating between the true AI native companies and those that are, just sort of sprinkling or bolting on AI components? What's the differentiator for you?
Well, my degree is in cognitive psychology. And I'm watching your body language. It's the same as when dust was being sprinkled. So I'll say something about blockchain. You could tell when blockchain wasn't needed if you could solve the same problem using a federated database. Then you didn't need it. You
And
could use it,
And
but you
therefore,
didn't need it.
and therefore, there's no blockchain applications.
Right. and that's one of the reasons it didn't grow the way it should have.
I don't
So
think AI is going away, though.
So with AI, if you could build the same thing without using agents or LLMs or foundational models, if you could do it another way and come out in the same place, then they've sprinkled AI dust on it.
I've seen that, and
You've seen it.
I've seen also the AI washing.
Yes.
So within
It's like greenwashing, only with AI.
a portfolio company of mine, not an AI company, but wanted some AI fairy dust on their investor presentation. There's an AI slide, and the thing I said to the CEO, I said, every one of these things is true that you say you're doing with AI. But you could also say the exact same things about where you're using electric lights instead of kerosene. Like, oh, we're using them here so they don't get soot on the wall. And then we use them here so we don't set the ceiling on fire, and see how we're innovative. I mean, like, everyone is using these AI tools the same way.
Yeah. So let me push back a little bit on this. First of all, to Zach's point, we have been working on intelligent agents since roughly, I would say, 1983. We did. Yeah. Anyway,
It's called workflow.
so the second point is that just because we can solve a problem doesn't mean that we're solving it intelligently, efficiently. So there is I would say, in several instances. Okay, in several instances, we are able to address problems that we were not able to address either at all, or we were able to address them only very inefficiently or very heuristically or very incompletely. So I think there is just because a problem has been solved in some way before doesn't make it an uninteresting problem to address using AI. Now, the difference here is, and as I was saying before, the difference is try to understand what the AI centricity is going to bring to the process, right? To the business process that you're trying to do. If you're just replicating an existing process and you're saying, now I'm doing something with AI, that's not good enough. But if you are completely rethinking the process, I'll give you two examples, portfolio companies. We have invested in a company called Divergent 3D. So Divergent is based down in Los Angeles, and they are able to rethink manufacturing. They have developed an AI system, kind of like an end-to-end, from material design all the way to the production of the artifact, that allows them to do two things. First of all, the first application area was automotive manufacturing. They were able to reduce, during that entire process, 650 AI-related patents, by the way, but they were able to reduce the weight of a conventional vehicle by 85%. Okay, that's a big deal. That's a big deal. Even if you're using ICE, internal combustion engine, a vehicle that is 85% lighter is far more fuel efficient.
So let me just ask you, and I'll ask the panel, if, go.
One more point.
Okay, yes, sure.
Now they're applying the same process on defense. They are able to reduce the amount of time that it takes to design a new system, let's call it, from about 2 years to 16 weeks because of this process. Now, that's what I mean. Those problems have been solved before, the problems they're tackling. It's just that they were taking a lot longer, they were less intuitive, and they were having a lot more side effects than the solutions that these companies provide. And there are many of them, there are many such examples, but I'm being...
Okay. Well, let me ask you, Jennifer, if a company doesn't have a component of AI, ML, DL, I mean, are they going to succeed in today's market?
It depends on what they do. They definitely need a strategy around it or to be thinking about where to use it. I prefer the company that comes in and says, I'm solving this pain point for this market customer, rather than I'm the AI company, because I want to hear how is that technology getting baked into your product, and is there a return on the investment that you're spending in there to do it. I don't see it as something they have to have, but everybody's doing it. They definitely need a strategy and to be on top of where the market's going because of competitive pressure. We're also seeing companies use it internally more so that, especially an early company, that can grow to a much more mature level more quickly, utilizing AI themselves. We use it at Mighty Capital for some of our internal processes, not to make a decision on an investment, but maybe on getting that due diligence memo done, or how we work with our CRM. And we're just like we saw with cloud, 15 years ago, you could spin up a company without buying a Sun server. We're seeing, companies get to a much more advanced phase more cheaply, more quickly, using automation themselves. So drinking their own Kool-Aid so they really understand it. But if it's, the sprinkling, throwing it on a slide, do they have to have it? Only if it really matters to their business. It's hard not to see it being in everything, everywhere at some point. So if they're putting their head in the sand about it, that's concerning. But if they're leading with it before they need to, or before the market is there, they're probably not spending their resources on what product, on making that product as sticky as it needs to be and scaling up their organization to own that category or own that market segment. So it's about focus.
You don't think customers are going to be demanding that they're buying smart products that provide insights, that manipulate data?
I think we do customer calls. The most important call, like what problem's being solved, what's your return on investment. They kind of don't care.
Flying monkeys, AI, whatever.
They don't need to know how it was kind of don't care. They may worry. In fact, AI can, for some industries, be a problem. If you're selling into media and entertainment, what's the impact on copyright laws, security issues, compliance issues? So sometimes it's actually a problem.
I think Jennifer's touching on a super important point, which is over the last few decades, we've seen the cost of getting a company to a certain level of traction go down and down and down. And with AI, the curve has taken a steep downward turn. And we'll start to see, and I think impacting our own venture industry, where it only takes $1 or $2 or $3 million to get an attractive company like Zapier, profitable and hundreds of millions of revenue. I think that's going to become a lot more common.
Yeah, just case in point, we've seen two companies. One we're probably going to invest in, $1.4 million in investment. They're already past $1 million ARR. They only need to raise $2 to $3 million to get to break even.
Wow. You can have, we see enough companies that have not much to do with AI. Like they don't have any AI in the product, but the problem they're solving is a real pain for the customer, and that's where it's at.
Yeah.
It's like like a query engine. It's like it doesn't do AI, but it's 4 times faster than anything you have, and it's 60% cheaper than anything you have. Any questions? It's like, you know,
So I just want to touch on something. I think is Jennifer brought up the question of moat. And it seems like every time, when my clients go out for a pitch, one of the first questions is, what's your moat? So just opening it up to the panel, how do you evaluate a moat and defensibility in AI companies where the core tech is increasingly becoming really commoditized? So how should founders be thinking about a moat, and what's the best way to build one? And I know, Jacques, in your book, you sort of advocate for a very narrow market entry where you could be the leader from day one. And that kind of sounds like, first to market strategy, but often second mover advantage is more powerful than first mover. So what do you see, as a defensible moat for AI companies?
Actually, I was gonna ask Jennifer a question, so let's have it this way. I think for me, the question is, if you have a company that can go from 0 to $100 million with $1.5 million in venture capital and can get that kind of velocity, isn't by definition not sticky because the next one could do the same?
That's a great question.
And so to me, the difficulty of inserting yourself into the customer workflow, the difficulty in going through the requirements to satisfy an enterprise is almost going to be the mode, because the technology is not going to be.
Have found her market fit, right? What, legal tech. You better be, come from the legal industry if you're going to enter that market, for example.
Right, but the point I guess I was doubling down on that is, if despite that you can get from 0 to $100 million in 9 months, the next incrementally better technology in the same space can too, because if you could get adopted so quickly, you could be replaced as quickly.
Agree. So you need to exit ramp at the right point, right?
Or you have to do something a lot harder, or you have to aim for something a lot harder.
Yeah.
So I will put it this way. It really, as you said, we're dealing with a new stack, and enterprises understand that AI is ushering a new stack. So to me, when I look at potential moat, is at what level of the stack you're starting your solution from, right? I mentioned Divergent, and they're going pretty low in the stack in order to be able to offer the kind of capability that they do and the kind of ROI that they do. We're seeing other companies that we have not invested in that they start with a very high level of the stack, and then the defensibility becomes far more problematic. Now, the amount of capital may be less. Again, by comparison, a company like Divergent so far has raised about $250 million. Now, when you talk about a company that is raising $1.5 million, I don't think, with all the brilliant people that we have in that company, I don't believe that they could have done what they're doing with $1.5 million. But again, where you're starting this new stack, and I underline the word new, is important.
And I agree with what Jennifer said, because if you're using very industry-specific models, and I don't mean manufacturing, I mean understanding this kind of chemistry, understanding this kind of material, understanding how drug discovery for these kinds of proteins is done. That's a real moat.
So,
Sorry,
Go ahead.
I actually want to bounce on that. We're looking at a company that's doing protein discovery, and we are getting, and we do healthcare, so we know what we're talking about. We're actually getting convinced that unless they have their own lab and they're going to do wet experiments, that they don't have a moat.
Sanjeev?
the point I just wanted to give the thing that I talked about earlier, which is the vertical SaaS to vertical AI, right? So if you can create a system where you can help build a system of record for the customer. That is, it's a piece of data that they can't do without. They can't run their business without that. And that's how, Salesforce and ServiceNow and all these companies started, right? But in the AI world, if you can come to this system of action, that is, you can actually do things. Like, for example, a system that trains sales reps helps you create the playbook for how to ramp every sales rep coming into the company. Well, not only that, you can turn it around to maybe make it part of the interview process to hire the sales reps, the right sales reps. So it actually leads to other workflows in the company. And as long this is called data gravity and workflow gravity. There's a notion of this thing. And as long as you have that, you'll have staying power in the account.
Yeah, I want to pick up on something that you said, Jacques, and that's, one of the motives getting into the enterprise. And I guess, for all these entrepreneurs here, their dream is to get into the enterprise. And so the question for the panel is, how do you overcome the cold start problem where, the entrepreneurs are early stage, they lack the key signals of credibility, such as, existing customers or case studies or success stories, or user data. So how do, in the real world, when you're starting out and you're developing your product, how do you get into the enterprise to build your moat?
So that's really easy. You get money from investors who have good connections, and you go to things like this and meet people, and you leverage your network.
And or you come from that industry. And if you don't have those things, you better be super hyper focused on a really narrow beachhead market where you can establish yourself.
So
Can
to that point,
I do that? Thank you for the narrow beachhead. So the principle of the book and the class that I'm teaching is actually based on the analogy of the D-Day invasion of Europe and the argument that you could only attack Normandy. You could not attack Normandy and south of France and Italy and, Norway at the same time. You had to pick one market and put all your forces on that one. And that remains true. If you want to penetrate the enterprise, you got to go narrow and put everything you have on that. And you better know why.
So just to pick up on something you said, Eric, it sounds like founder market fit is really important to you.
In an established market, it's absolutely critical. If it's a brand new market where there's no existing anything, well, then it doesn't matter. I mean, I'm a little simplistic, but there's a continuum.
Generally speaking, how do you folks look at founder market fit?
At the stage I'm at, where they typically have million-ish of revenue, I really look at how well they're interacting with the market and getting customers on board. And if they're spending $1 to get $2 of revenue, that could be good, could be crummy. If they're spending $2 to get $1 revenue, that's definitely crummy. There's a lot of data that you can get from the early customer interaction that the company is having when they're actually asking for money that I find very, very powerful predictor. And sure, you take risk on, hey, have they just found the 1,000 passionate customers? But I'd really rather have 1,000 passionate customers who are growing like crazy than, well, it took us 2 years to get to here and the customers kind of like it, but we've got revenue.
Look, this is not, I don't think that AI makes any difference to what should be the composition of a strong early stage founding and by extension management team. So we look at the so if you look at the founding team as an example, we want to see complementarity of skill sets, right? We don't want to see a tech heavy team. We also want them to see how they interact with customers. I mean, is there one person that dominates every conversation, or is every member contributing something to the acquisition of that customer? And that's particularly important to the first 10 customers of the company. Even if there is no revenue coming immediately or at the time that we invest from these customers, how these customers were acquired and how they were convinced to go with this startup is very important signal for us.
I agree. It's about how people interact, because if the founding team is good at building relationships, they can work with each other, with their employees, with their partners, with their investors, and they'll be well engaged with their customers. And if they don't have those skills, they can't build the network, they can't do the things that a founder needs to do if they don't have that kind of skill. It's learnable, but it's also partly a personality trait.
I think, every founding team has to ask themselves, why us and why now? And if you can't answer that in a way that makes you unique, then you're probably barking on the wrong tree. And I think the wrong signal, and I'll disagree with Deb on this, is getting that input from your VC relationship is actually a negative signal. If you can't get to that information by yourself, then you don't know that industry and you will never know it enough.
So I heard complementary skill sets on the founding team. What are some of the most important characteristics that you folks look for in the CEO or the founding team?
That's tough. I like people who get stuff done. And we've not an investment that I directly led, but I was a partner in a firm where we led an investment and the CEO was a total jerk. And it was an absolute home run for us. Home run. So it is not a thing that I filter for. I filter for, are they getting progress on the business?
So there are no characteristics that turn you off, and even if there is, fantastic opportunity, you say, I'm not investing in that CEO, that team.
So, I mean, if there's fraud or if I get any whiff of, I can't trust this person, well, then no, I don't go there. But I don't have, and I know a lot of good venture investors have the, would you fly to Japan with this person in the seat next to you as a test? And I don't do that. I don't have to like them.
How about for you folks? What are the most important characteristics? And would you invest in a jerk?
I think for us, we want people that are factual and not overselling, because you can't run a business unless you're willing to face the truth. And so to the jerk thing, I can maybe accept a joke, probably not, but I could. But usually jerks sort of stretch the truth. I'm not saying lie, but sort of, embellish. And it's really hard to build a business. It's hard to go to a board meeting where you have no idea whether you can trust what is being said.
So in a period like what we have right now, it's very with the high velocity of financings. It's very difficult to filter out jerks from no jerks, and particularly if you're investing in early stage, it's you have to go by reputation, right? So when we have the time to do diligence and do deep diligence, we take full advantage of it, and thankfully, because of the years in the Valley and the venture network in general, we can get some good information, but not always. I mean, I can tell you of, over the past 10 years of at least 5 companies that were jerkful.
Yeah, if I may. Usually like a solo founder is tough.
Do you invest in solo founders?
Almost never.
Okay.
Sometimes, but it's rare. But so it's nice to see a team, at least a team of 2, 3 is ideal. People with, they bring different skills to the table, right?
But are there any qualities that you look for, like a great storyteller from the CEO, or what qualities you're really looking for?
It's really the, addressable market and the product, like how much impact it could make. And the other thing we look for is, are they coachable? Are they receptive to some feedback? Are they receptive to pivoting to something else? Because they would probably have to. It's like, so the other thing we look for is the ability of a team to actually pivot, which is both in terms of intellectual or horsepower as well as execution. Ideas as well as, especially in AI. AI is like changing, every week there's something new.
But how do you assess that? They come in, they're early stage. How do you assess whether or not
So
they're
I think
able to pivot?
right. So coachability part, we can tell, like if we go through 2, 3 rounds of sessions, we can tell. And the IP part, sort of a proxy for that is like number of PhDs on the team or something like that, which is ability to break new ground on something, right? So we're looking for something like that.
I think it almost depends on what you mean by a jerk. So I don't need to fly to Japan with a founder. In fact, I probably don't care to. But you could have a meal and see how they treat people. And I think the way people are treated says something about their abilities. And you could say that somebody who doesn't treat people well could build a good company, and I can think of a couple of big companies that were built that way, but it's not the majority. Usually that doesn't work out so well. Not always, but
I think, on top of what everybody else said, we're also looking for, this is a really hard job and choice. CEO of a startup, super hard. The grit and the conviction and the ambition, right, to do something big. If we see signs like, I'd like to exit this in 18 months, signs that they're tired, that they're worn out, that they don't really have it, that their families aren't behind it. Because I've had CEOs ask me, how do I get my wife on board here? Because yeah, how do I tell her that, we need to keep going? And, there are a lot of hard times. So just that grit, conviction, and the smarts, I think there's something about the smarts to like be able to, figure it out and not always come to you shouldn't be coming to us for like solving your micro problems, like, and the strategies. So those sorts of things.
I did a fireside with Saeed Amidi a while back, and he said he always asks the founders, "What's your plan B?" Because 80% of startups fail, and when they tell him their plan B, he says, "Next." Because he wants a founder that is all in, that true grit, that determination, that conviction, and there is no backup plans.
I wonder if he's just getting people who've been coached how to answer that question.
Yeah, I think after the fireside, which was up on YouTube,
It's called burn the boats.
yeah. So, we've got captive audience here of VCs, and I'm sure people in the room want to know, what do you see as the biggest mistakes that founders make in the fundraising process, in the pitch? I want people to have actionable takeaways tonight. Is there any advice that you can give them, besides optimizing for time? I mean, I see founders just totally waste so much time with investors that are wrong for the company, stage, check size, whatever.
That's a big one.
Yeah.
The goal of your first pitch is to get that second meeting if there's a fit. Maybe there's not a fit for you at this VC. Maybe we're the wrong stage or whatever. Tell us the story of how you are going to make money. How are you going to make money for our investors who are we were accountable to our investors. They want money back. How are you going to, really build a big company and return capital? So within that and the time management, a big mistake sometimes, and I know VCs vary in this, too much time on your baby, on the product, and not enough on how you're going to, what the strategy is, what your projections are, how you're not going to run out of cash, all of that. So how are you going to build and attract a team?
My number one piece of advice is around the target investor list that you build. And the overwhelming majority of the time, the list is haphazard at best. And it's just, here are the 10 names of venture firms I've heard of. I put the names on this list. Those are my targets. And it is so easy to do some basic research to find out who are the firms that have invested in companies that are kind of like yours in your sector, check size the right size. Some of them only do specific geographies. Do the work, find the firm, and then find the right partner. Get to that person. It's not a big nebulous firm. We're not, big firm, a well-run firm, they'll hand the deal off to the right person. In the other 80% of firms, which are absolute unmanaged garbage inside, if you hand it to the wrong person, they're like, this isn't for me. And then you're dead. You can't get anywhere. Like, put it in the CRM as a loser company. So you need to be careful about the firm and the partner that you reach out to. There's a cost associated with every one of those. Don't just willy-nilly send a bunch of emails out.
they're going to be on your board.
Yeah. And this is some of your friends recruit to be on your board for the next 8 to 10 years.
I'll take it one step further. I actually, asked the team to think about the partner they want to have on the board. What skill set would they really appreciate having that value add from? So if it's about scale, someone that's built a company, scaled it to 500 million and sold it, that venture partner probably gets it. And so being strategic, I think, is absolutely crucial.
I have 2 tips. So one is that your first 3 pitches should not be the ones that you want to raise money from. No, the first things first, right? It's like you get your pitch going, and the second is that it's better to aim low and end up higher in terms of raising money than the other way around. So so you can say you want to raise, let's say, 10 million, but you say that you're raising 8, and then if see the demand and then let it go up. So it's better to
Well, hopefully, I mean, my founders, when we go out, they've got a really good model, exactly what they need, what the next point is, and how much they need to raise. So, if you're going out and you're asking for too little, I mean, maybe it says something about the founder that they haven't got the right model to get that next.
This is the initial round. Let's say the very first time you're raising money.
Yeah.
But once you're like in Series A, then there is a track record of revenue, and then it's like the market takes over.
Just a couple of last questions. I know Rob's flashing the 1 minute sign for 10 minutes, but just a couple of mistakes that people make typically in outreach and follow up with investors. Besides the spray and pray, which I tell my clients never, ever, ever adopt the spray and pray. But what do you see consistently in terms of the outreach or the follow up that just kind of is just bad news for you?
I don't think you can script the follow too much. The place I sometimes get frustrated is the instantaneous crummy answer, right? So I ask a question and they get the answer back in a minute, and it's not a very thoughtful, good answer. And I'd rather get a good answer in an hour or 10 hours than get a crummy answer in 1 minute.
But obviously responsiveness is important.
I think, yes, but the timeline for the decisions we're making is measured in hours and days, not minutes.
Right.
And it's not like dating where minutes matter. It's a different kind of responsiveness.
I think people need to be respectful and respectful of people's time. I stopped printing my mobile phone number on business cards because I had founders who I'd barely met call me on a Sunday night at 11 o'clock at night. Did you get that? Did you send thing over? What do you think of all of that? And that's just rude. And Heidi Roizen once said something that I've always remembered, which is a lot of introductions are made through warm introductions by other people. Do not ask a friend or an investor or another founder to do something for you if you don't lay it out clearly and you don't help them write it. If you just say, can you introduce so-and-so, and you don't tell them why, and you don't say who you are, and you don't say what you want them to know, don't do it.
Okay, last question, Rob, I promise. What are some of the most important questions, maybe 1 or 2 questions that a founder should ask you before signing the term sheet?
So I'll answer the previous question and answer that one because you didn't let me answer the previous one. So
It's his fault.
don't forget to do reverse diligence. The jerk is sometimes the other one, and often the other one. And so you cannot fire your VC. You're with them for the rest of the life of a company. And in as much as we'd like to believe that VCs help company, there's a lot of VCs that hurt companies. And so you need to do your diligence on the person you're getting into. And so to your question right now, can you give me the name of 3 companies that you were on the board of that I can call and ask for a reference?
But the reality is someone going to give you the name of a company that they've tanked? Probably not. They're going to give you, the best successful companies. How would you feel if a founder did diligence on you and just went to your web page, looked at some portfolio companies, and just called 1 or 2 founders?
I tell them to do it.
Hey, do it. Okay.
I tell them to.
Okay, that's a fantastic sign.
Yeah, I think they've been doing it actually for a while. The point I was going to say is that a question that is going to welcome from the entrepreneur is asking us why we invested in specific companies. Pick up a company and say, why did you, from what's on the website, so why did you invest that? And have us go through our rationale and see how our rationale fits with how they're thinking. Because I will also say that, I don't know if it's 80 or 90%, but most of the deals that we see are not really venture fundable. entrepreneurs, particularly in this area, think that if I have an idea and I want to start a company, it needs to be venture funded. And
You
I
mean
can-
like mattresses?
Yeah.
I can guarantee you that most of the companies are not, because they don't fit the return profile that a venture investor needs to present to their own investor. Right? We're just middlemen.
I think that's a great question. I always ask my entrepreneurs to ask the VC, why are you investing in our company?
I should also ask why they passed on other things.
Yeah, but I think having an alignment of interest is so crucial, and I think so many founders are just so happy to get a term sheet. They don't ensure that there is a great alignment of interest, and that could be problematic.
Yeah, and part of that is you want more than the check. Ask, other than your money, what value do you see you can bring to my company? And we actually will only invest in companies where we see we can do that. It's part of our assessment. But I think that's a really key question, and it tells them you're thinking about more than the money.
I guess it also depends on the way you ask, right? Because we handle with Efrain. Someone in the audience said, "Tell me your superpowers and why I should take money from you." Something along that line, and he just went mic drop.
Yeah, the way you
asked you.
Yeah. Yeah. Why should I take your money? That's not a good way to.
Any final thoughts on what an entrepreneur should ask you?
That just circling back on the reference checking. So, I mean, the Nirvana case, of course, is to have multiple term sheets from your favorite investors. The reality is 90+% of the time you end up with one term sheet. And I've had these conversations and the entrepreneur like, well, I have to take the term sheet. It's a reasonable term sheet. They're not screwing me over. He seems like an okay guy. What am I going to what are the references going to tell me? And I strongly advise them to check references anyway, because A, maybe you find out they're really horrible. Most likely they're not going to be that bad. B, you learn how to work with them, right? Part of any good diligence, reference call, you say, oh, hey, you've had the benefit of working with this person in the past. Any suggestions on how to work with them productively? And then C, it's signaling. It shows that you have maybe some other options and you care about whether they're good investors to work with or not. And so for those three reasons, you should, even if you're only going to get one term sheet, still check the references.
Excellent. Thank you. Quickly, just from right to left, what's the best way for folks to get in touch with you?
You can email me directly or find me on LinkedIn.
Sanjeev at fusionfund.com.
Okay, so this is going up on the web.
Rob has our email addresses.
I don't know if you have a backup email when this one blows up, right? And we did that with Patrick Sellier. We did a fireside, and he called me up the next day because he had like 140 just from the night before. But anyway.
Same. Eric at tanitas.vc.
I'm going to do a different tack there. If you want to reach out to us to get into the top of our funnel, if you're ready, if you're in market, have revenue, dealflow@mighty.capital, because they will parse it out, which is a good use of time. You send it to me, it's probably less likely to get noticed just because of volume. Otherwise, LinkedIn.
Excellent. Thank you so much to the panel for your time and incredible candid insights. Thank you so much.
Super bad. Roger, do you want to be contacted?
Sure. Snell and Lomer, my email's on the web.
Well, Roger will be contacting you most likely anyway. So now it's time for audience participation. So if you have a question for our panel, step right up. We'll have a line right here. Step right up with your question. This is not a pitch event, so do not deliver a pitch. If you deliver a pitch or it's any of this guy's pitch, you have to deal with Melissa, our bouncer. So first question.
Hello, everyone. First of all, thank you very much. This is very insightful and very informative. So thank you very much. My name is Sumit Nair. I'm the founder and CEO of Journey360.ai. And we are the only company who is actually trying to accelerate time to value for enterprise customers. And my question to you is, there are many first-time founders and there are serial entrepreneurs. So is there a bias that, hey, I would go for a serial entrepreneur versus a first-time founder? And the reason I ask that is because I'm getting a lot of incoming from seed investors, which the money is very low. But to get to you guys like VCs, We do a lot of cold emails. So do you guys look into cold emails versus how can we approach to people like you?
I mean, you can email me. It has to be dead center sweet spot awesomeness for me to respond. And you're going to be much better off if you get a warm intro, right? So anybody you know who knows me, you're going to get so much more likely because that person will help filter out the things that they know is not a fit for me.
I mean, in all honesty, does anyone here respond to cold emails?
I do.
Okay.
Like
It,
once.
it depends what
twice
it
a year.
depends what they say.
Yeah.
If they're thoughtful and eye catching and compelling, yes. And if it's just the usual whatever, no.
You have to be very clear as to what is it that you do, why is it exactly what I'm looking for, and then a very, very short why you, why now, and what's that unique. If I get an email like that, I will at least answer with, I'll flip through a deck, send it to me.
Hi everyone. My name's Catherine. So I'm currently I'm currently working on AI pet hardware startup. So we essentially embedded AI technology into like a fluffy animal. In the future, we might be working with Disney or some other toy brands so that we can enable those AI capabilities into them. So I just have some questions regarding, since many of those hardware companies actually have some of their team members based in China, which is actually, has a very fuller supply chain versus the US and has lower cost of making robotics and other hardware products. I was wondering, what's your take in terms of investing in international teams, not limited to investing in Chinese team, but also, maybe other international teams.
Well, yes, international teams for sure. Probably not ones that are based in China.
I think that's the honest answer.
And we don't usually do B2C businesses, but invest in US, Canada, Europe, mostly. Yeah.
I don't have quite as hard a line on it, but I would only invest if the company was based in the US, so the CEO and legal domicile. I'd be nervous if most of the intellectual property and equity value of the business was based in another country. But certainly lots of companies in my portfolio have like a development team in another country where it's cheaper. But if the core of the value proposition of the business is based in China, I think that would be very difficult for me.
Is hardware still so hard?
Yes.
Yes.
Yeah,
I think there's like 3 or 4 funds in the valley that would do hardware.
Yeah, I mean, I've got clients that are doing hardware, but have got software and, all kinds of bad stuff. And you just can't position it. If you have a hardware component, it's just not infinitely scalable like, some code.
I know individual investors who invest in hardware that are possibly at other funds. Well, they are at other funds because I was supporting our hardware team at IBM. So I sought them out. There aren't a lot of pure hardware funds.
Actually, there's sensors. Sensors plus software is a fairly common combination in different verticals, different industries. And I've seen that in like fleet management of trucks, for example, or even like predicting uptime for manufacturing machinery, for example, by embedding sensors. So the most hardware that they do is get to the source of the data, but once the data is there, it's all software.
Yeah, but it's still much harder than
There's
just a pure software player.
Correct.
Just
Margins are lower.
factor.
Margins are lower.
Yeah.
Yeah.
Thank you.
Hi, Dylan Gittleman. Some of you might recognize me. I was head of business development for several service providers in the Valleys. Roger, Jack, you remember me. I know Fusion Fund pretty well. And the last 7 years, I've been an investment banker, and I'm working with all types of companies. So on the large side, we're getting Seeker, which is an A round, $1.2 billion valuation. But most of the companies have under a $50 million valuation, going for like an A round, a seed extension, or maybe a B round. And so, Jennifer, you'd mentioned something that came up a few times with the companies when they're presenting to us. They said, well, we only need $5 million to break even. Now, a few years back, I remember the mantra was, first of all, your company had to have something better, cheaper, faster. You wanted to grow it, and maybe it's better, cheaper, faster, 40% plus. You want growth of 40% plus. And when these companies said to me, I could get to break even, I was saying, don't mention that in a VC pitch, because maybe you should think of raising more money, because there is a speed to market. Because no matter what kind of moat you have, we've seen over and over again, you only have a few years where you have a competitive advantage, where you're eclipsed. And we've seen chips. Chip design is a perfect example. You better move real quick on that. You have a 12-month, 18-month. But are you seeing more and more where some VCs want to see break even? Is that even a
I think, yeah, that's a good question, right? Because VCs, we're looking for the big exit ultimately, right? We're actually seeing this investment space between seed and A that we're calling discovery. I actually wrote a term sheet now for discovery preferred. And it's like they need a little bit more money to get a certain metric where they then have optionality. And maybe it's, most companies need to raise at least 10 to get to cash flow break even. It's about the option of it. It doesn't mean that you should do that. As you get more traction and proof points in the market, do you want to further investment and start doing the alphabet soup, do the ABC track, or do you want to do a different kind of track with it? I think we're going to start seeing M&A heat up to pluck, some of these sub 50 million.
Take more money and ROFI that is more, because that's impressive.
Yeah. So from our perspective, it's how much do you need today for 18, 24 months to get to what goal, to what metric, and don't get overly diluted today on what you might do with the money 3 years from now, but stay cost efficient, cost effective, get your gross margins where they need to be. A lot of companies, that's a big problem right now, actually, gross margins. But have that optionality. But of course, as venture, we're hoping you keep growing. We don't want you to start. I actually just told a company that they should raise a little bit more money to make sure that they're growing. So instead of targeting this ARR, double it. How do you triple? How do you triple your growth? Is it the right number? And have you done, really? So maybe it's not the right venture. Is probably not your path, right? Yeah. Yeah.
What do you think the most common misconceptions are that founders have about dilution and valuation?
Oh my God, that's all over the place. Because, of course, they don't want to get overly diluted. We don't want to see them overly diluted. Ideally, a team still has 40% after an A. That's getting really hard to find for some reason. It is important because we want incentives aligned, but sometimes they do raise less money because they're worried about dilution instead of growth. It's tough. And valuation, their expectations are, of course, beyond ours typically. I mean, it's always been that way.
One of the questions, similar is my goal, where you're having some companies.
Yeah.
Huge A round valuations that I'm going to start with the theologies as Secret XP.
Yeah.
Oh, I know it's the goal for an A round, and they're $1.2 billion valuation.
Yeah. So a lot of
the reppies are under 20 million. And then I'm like, well, all these other companies with their art sucker, you get a $30, $50 million valuation, and they have good products.
Yeah, there is definitely a bifurcation there, especially in A, where it could be a $5 to $10 million A or this massive A, and the big billion plus funds are in that other side of the spectrum because of the way the economics work.
Does anybody else have what's going on? Are you thinking that there's that .com bust?
No, we said that before. There are 5 companies that are getting the bulk of venture investment.
Yeah, I think there's a dynamic, though, which is not easy to explain, but when you live it, you recognize it, which is there's a whole bunch of funds that have so much money that they don't know what to do with, that they want to play the numbers game with very, very big checks. So you'll see a whole bunch of 20, 30, 50, $100 million Series A, and you think, oh my God, those guys are crazy. No, they're looking for the option to put $1 billion into the company. And so the problem that you're having, and a lot of founders don't understand, is you're just a number for them. Like, they really don't care. They're just buying option value and people get really badly mistreated if they don't understand that that's what's going on.
Right,
But it's
so-
hard to explain.
Guess it really depends on the team, right? We were talking about Mira from OpenAI. The CTO just raised 2 billion on a 10 billion, and she has no company.
No, that it has to do with track record. And if you've been successful, like if you're start on your fourth venture after 3 exits, you can raise money without a problem, right?
But Jacques is right. Look at who put the money in.
Yeah, and if you don't have that, then it's a question of like what is the brand value of your backers themselves? Like I've seen AI companies spun out of Stanford, where there's certain profs that are invested in the company, regardless of the founders themselves, the valuation is very high because of the profs.
By the way, there's some controversy around should you invest in repeat founders or not. And the data is absolutely not clear that you're more successful with repeat founders because they'll make different, bigger mistakes. And so we tend to lean that way. But within the fund, I'm one that's like, be careful because, they'll be successful in this situation, in this company, in this market doesn't mean all that much for the next one.
Great, thanks. Come on up, George.
Thank you for being here tonight. My name's Gregory. I'm CEO and founder of Cash Monet, a fintech tool startup in the enterprise B2B space. Recently, I met a VC, followed up from that initial introduction. They want more information from my company and what I'm doing. In doing my due diligence on that VC, I found out one of their seed investments is a company that we would utilize as a data input tool into our model. And I'm wondering, it looks attractive. How do I navigate that to make sure they're not just pulling information for me to feed their investment for their product roadmap?
I mean, any VC that respects themselves would never do that. And if they thought there was any kind of sensitivity, they should actually decline to talk to you anymore. Do some background diligence. There's VCs, won't name names, that play fast and furious with this stuff, but the vast majority don't.
Your fear is that they will take your data, hand it to this supplier to you, so the supplier will get a roadmap to forward integrate into building what you have? My product is a business intelligence layer pulling from the RAG on top of an LLM, and their seed investment is pulling from the cloud. So I want to use their portfolio company data to pull into my model for my customers.
But if that portfolio company could just look at your website and see what you do, if they loved it, they would go copy that.
Yeah,
But what's in your pitch deck that's not on your website in terms of your product? It seems like a thing not to worry about.
Okay. Yeah, it looks like a good fit.
But actually, be careful. There may be a portfolio concentration issue. Like they may not want to invest in 2 neighboring companies, depending on the size.
All right, Arif.
Thank you so much for your time today. My name is Ari. I worked in a few big tech firms, engineered a VM, got some scar tissue as a founder. And the question I have for this group, a lot has been written and said about how to raise funds as a founder, get your first funding, and so on. I'm very curious about what advice do you have in terms of raising your first fund as a VC yourself? So when you approach LPs, and in the first fund, you have the challenges of maybe no prior exits, record of exits, or deal flow. So it's that's my question.
How do you become a VC? How do you bootstrap into a VC?
I think that's out of scope.
I can take a shot at this. So there are a number of places that you can first build what I call your investing muscle, which is there are a bunch of angel groups like Sandhill Angels, or there's a whole bunch of them. Okay. And that's one. The second is you can work with places like Berkeley Skydeck, which is an accelerator, as an advisor. And again, see a lot of companies and what I call build your investing muscle. There are all the major schools of US have angel investing groups in the Valley, especially in the Valley. Okay. That's another area. And then you got to figure out something. I mean, you got to, and that's how you build a track record of some investments. And then I would check out VC Lab. All right. Then you're in the right place. Okay. Right.
Great. Thank you.
Hey, hi. Can you hear me? Yeah. So I'm Sam. I'm a founder of an AI-based content moderation platform.
Could you hold it a little closer?
Yeah, I had a bad episode when I was a child on a public speaking, so I have a throwback for mic. So yeah, so I'm Sam. I'm a founder of an AI-based content moderation platform. We have the largest number of content moderation filters in the world, and homegrown. We don't use OpenAI or anything. So my question is simple. What is a market validation? So let's say we have acquired first three, four customers who are exactly from our market leader, and assume the market leader is worth $4 billion, and we acquired first three customers from them. Is that a market validation?
What constitutes traction?
And because of the mods, not because of the price. Yeah.
So how much are they paying you, these three customers?
Around $8,000 monthly together. And in 3 months, 4 months, go to market.
And I'm sorry, how much are you looking to raise? What?
I've not thought about it, but we already raised angel funds around 100K at the valuation of $4 million.
So actually, the question is, the key point is repeatability.
Okay.
Are you at a point where whatever you are offering, right, your content management platform, if you get your fourth customer, how many new features do you need to develop for them before they deploy it? That is, every time you get a new customer, do you need to enhance the product? If yes, you don't have repeatability yet. Okay. So you need to get to a point where you need to do zero development before you can onboard a new customer, and then you have something that's like
Getting you ready for Series A. You're still a long way from that. So okay, so you've got 8,000 from three customers.
It's absolutely repeatable. So basically, we are configurable. We don't need to do an extra development. We don't need to. We just need to click the buttons. So basically, it's like this. For example, I mean, I'm worried if it's turning into a pitch or something.
No. So you're based here in the Bay Area, or
So I'm in the Bay Area. So the Delaware
8 to
corporate-
10 million valuation. Next.
Yeah.
Great.
Thank you.
Hey, Brian.
Right? I mean,
yeah.
Hi, I'm Brian. I work at NASA, but I'm leaving soon to work on my own startups. The question was for Angelos because he had mentioned divergent thinking a couple times, which is a theme that I've heard on many occasions coming to these. I wanted to know for what types of the top things do you see in divergent thinking for founders? What would be good examples of divergent thinking?
What thinking? I'm sorry?
Divergent.
I think that being the founder of a startup is often a lonely and intellectually difficult undertaking. And the rational people often don't do it because it's so damn hard. And so there is a high correlation between craziness and willingness to start a company. And I use craziness as sort of like a shorthand for divergent thinking. But you have to execute, right? And I think that's the key place that matters, right? It can't be, I'm thinking big thoughts. It has to be, I'm getting big things done. And then I think when you're showing good results, people are happy to be impressed by that.
All right. Great. Thanks, Brian.
Hi, my name is Vivek. I worked in technology industry for more than 20 years, and now I'm a full-time investor. So question that I have is, in your own firms, how has AI helped you in getting benefits within your own process, or how it has widened the moat of your own firm against your competition?
You mean applying AI to the VC world itself? So one is that we use AI for gathering new developments in research of different kinds across different schools, which is an automated process. So this way we get to see what are the new things coming up that could be commercialized, for example.
Are you using them in any way to filter pitches or, look for inconsistencies in diligence?
No, that's still done manually. We don't, yeah.
In my business model, we only invest in category creating companies. And so often I'm looking at a brand new industry that I haven't covered before. If it's an industry that has venture experts in it, then I don't touch it because I figure the reason it's getting to me is because everyone else good said no. But if it's a brand new category, then I will dive in deep. And this is a place where, just like everyone else, right? I mean, I've totally replaced my Google searches with AI searching to come up to speed in a brand new category, which has been a godsend. I mean, that has taken that process from 10 hours down to like 2.
Yeah, we're doing a number of things. We actually have on our website what we call an AI partner, where founders can upload a pitch deck, and we built our own model against our criteria. It spits back feedback, so it's kind of interesting. Internal process as well. How can we do some of the mundane things quicker, more automatically? We're building an AI governance tool, which is sort of for internal, if there are questions around governance with the team. So how can we, upskill the team, upknowledge the team quickly, and that sort of thing. Yeah. A lot of information management.
Great.
Yeah. Thank you.
Thank you very much for your time. I'm Mike. I've flown from New Zealand last week. So I'm a founder. I've been a founder for 6 years. I'm an industry-based founder. So I saw a major problem in our industry. It came as a result of a massive medical event that happened in my family's life and resulted in one of my children nearly dying. And as a result of that, my very successful company, I kind of say it, when there's a crack in something, that's how the light gets in. And so I was cracked. So I had no background in technology. I didn't even know how to use Messenger. But I went to the market with this vision, and I employed 4 technicians around the world and posted them, and I started paying them, and I've been selling my own properties. We've been property developing now for 6 years. We've brought in $1.4 million worth of investment. But the point of this is that I've been writing to people in Silicon Valley for 6 years through LinkedIn, and I could show you so many emails, and I don't even get one response. Now, I've tried coming up from the point of view of being really humble and saying, there's not going to be much money in this thing, and trying to be all cautious. And then I've tried the whole just being honest about what I believe, which is, that by the end of the year, we could be back in $150 million, and I don't need $1 million to launch that process because we've built the entire software stack, and the software stack is enormous, 6 years worth of coding. My question is, I reveal what I think is achievable. I know it's achievable, and it seems too unrealistic, and it just seems like I'm a fruitcake, and like to your point, I agree with you completely, Eric, that, we are crazy. I've just sacrificed everything. My family sacrificed everything, and that's my founders are. So where's the balance between just being honest and saying, this is actually going to dominate this market. It's a new model. It's never been done before. We've got New Zealand's top corporate partners have joined us, taking shares in us, the top finance company, the top building company in New Zealand. Everybody's there, but no one here wants to talk to me. That's why I flew here. And unfortunately, Roger, I've done what you did, which we did the spray. What did you call it? The spray and pray. Spray and pray. So you've probably all had an email from me saying, would you like to be making
It's only a very small place, right?
Yeah. So they probably all had it. I'm sure they've all had it. And I'm very sorry if that's the case, because I've learned some things tonight. But I'm just a country boy from the South Island, New Zealand. It's really hard to try and connect with you guys. You talk about being a global epicenter for bringing in innovation. There's no question we're innovative. But how do I get through with the numbers? Where do I pitch that?
First, I'm founder of 2 venture-backed companies, so I'd say crazy in a loving sort of way there. I think the one piece of advice that I'd have is to show, not tell. And if you tell, hey, I'm going to make this, going to be $150 million of revenue, they're coming up soon, like I hear a crazy aspirational pitch in every story. But if you can show rather than tell, and show like what you've actually done, what's happened, customers who are using it, your initial revenue, how it's growing, these kinds of things where you can show the story as opposed to telling it, then you're a much more compelling position. And then the other piece of advice, if you've done the spray and pray, is target, right? Who are the 30 best investors for you in terms of size of check, sector, of some whatever other attributes? Have their names of the specific best partner of those 30 funds and link, your way towards them specifically, rather than sending them an email. Find out the companies they worked at, go to these networking events, see if you can get introduced to them, then network your way toward them. That's a much more likely to be successful than how you tell your story in an email.
So as stacks of what you might probably point out stacks, pretty I'll pass on to a lot of those to pickle, but they just it feels like you guys don't read it with the greatest amount of
The
respect.
reality is, you've got someone contacting you from halfway across the world. You've got so much deal flow in the valley. Even if you believe the numbers, even if you think it's a good story, I mean, are you going to get on a plane and go to New Zealand for a board meeting? I mean, is it
No.
Maybe there's not a fit with the investors you're seeking, and what's here, it may not be the right fit.
Yeah.
Right? Maybe it's family offices. Maybe it's, without knowing.
From non-view research, I can see that one.
Yeah. Okay.
And some investors just won't invest out. Like I don't invest outside the U.S. It'd just be simple. No, I don't do that.
It's probably hard to get you to invest outside of the valley. Yeah. Okay.
Last one, you made it. Ben Montclair, aspirational investor, friends and family round. So Jennifer, I think you mentioned that you'll do B2C, but there's a version generally for B2C, and I wonder what would have to happen to get around that bias, like to press through that and attract. Is it zero things or?
No, there's funds that specifically do focus on B2C. There really are. So I think it's like we were saying earlier, do your research on the funds that fit, that actually invest in that segment. And there are plenty that do. Most, I don't know, maybe a third do, a quarter do. I have no idea.
Hundreds, many hundreds.
I mean, yeah, they're definitely out there.
So don't try to persuade B2B folks. Just find your fit.
They're not going to be your best investor. They're not probably going to help you grow your business if that's not where their expertise is.
It's best for each side to stick to their knitting.
Yeah.
For each side. Right.
Yeah, I mean, really, just for all the founders, optimize your time. It's your most valuable commodity, and I see with my clients sometimes they really want to chase investors that are just not the right fit, and it's going to be really tough to take that round peg and get it into that square hole. You're going to beat yourself up and just deal with a lot of rejection. So I think it's really great advice. Find the right fit. VC founder fit.
Right, let's go for our panel. Whatever's left of them. Now it's time for our raffle drawing. Well, let's start with Jacques. Is Jacques still here? Yep. Well, he left a bunch of his books.
He left the book.
Well, let's start with the $2. So we have 2 of his books. Actually, he left 2 more over there, but let's start with 2. I guess he's not here to sign them.
Yeah.
Roger, you want to do the honors? Jacques isn't here to do the honors. The winner is
Jathan Ulal.
Jathan, our photographer. There we go. There you go. You've got a picture with Roger. Not the author. Let's see, Jennifer, you want to do the honors? Sure. Thanks for sticking around, panelists. Well, there's left of the panel. The winner is
Dulce Ponce Leon.
Ponce de Leon. Isn't that the guy that found the Fountain of Youth? You're right. Jose Ponce de Leon. Ponce de-
Natalie Tam? Or Natalia? Natalie. Natalie.
Natalie. That's a P. You want a picture with Roger? I guess not. Well, he's not the author, but the author went home. Yeah, no. That's why you get a picture with Roger. It's optional. It's optional. All right. Yana, what's your prize again?
Seas candies.
How much worth of seeds can?
Huh?
A lot of seeds can be.
So
Roger, you want to do the honors? Let's wrap this up.
Okay, and the winner is Shail. Shail. Is that? Am I going to see you guys?
Shail, gone once, twice, gone. Next. Why don't you do it? Why don't you? Hurry up.
Vivek Somani.
Come on down. Applause for Vivek. Well, go ahead, get your picture with Jan. In the meantime, grand prize, $25 gift certificate. Why don't you do the honors?
All right, guys. Grand prize. Da-da-da-dun.
Correct. Thanks. Hi, sir.
Mike. Fryer. Mike.
All right, congratulations. So, once again, let's hear it for our panel, our sponsors, our video and team, and our cement team. Applause. We have a live entertainer who's going to entertain us. Brian, you want to introduce yourself? Let's hear it for Brian.
I'm Brian, just introducing myself again. So I'm leaving NASA shortly and actually moving out of the country to work on my startups for a bit and then coming back. And so I play guitar, so I will be your neurodivergent thinking guitar player tonight.
So I have a gift from Idea to IPO to Brian for all his service to Idea to IPO. It's an Idea to IPO polo shirt. So congratulations. You want to put it on? All right. Anyway, so we're going to start the after party. We've got ice cream, lots of desserts. Stick around. Roger said we can stay here all night. So thanks for coming. Enjoy the after party. Applause.
Thanks for Rob.